thank you for coming today. Um, this time we're only the best, right? I don't know, maybe what's the reason if there is, we have some more popular stocks this time. Probably if we tend to have contrarians, no attending, maybe they want more less popular stocks. But anyway, for those that you're coming for the first time, we are the Global Value Investing Club. We operate in multiple cities, and the main event is here in London. We can freely talk about our opinions, but it's never a recommendation, so feel free to say your opinions, but don't take what we say as a recommendation. You can always go to cityfalcon.ai/meetup and see the presentations of the previous speakers. I always find it interesting to see presentations of what people say like 4 or 5 years ago, because you always see, you always can see like something that it's true, or if the investment didn't work, you can find out what didn't work. So I always find it intriguing. Regardless of how well it went, I always find it very interesting to go. And this is like, I think, a treasure to see how people in different times thought about different stocks. Yeah. And also you can see the actual performance. So, like what has happened, I think, in the past two months, what is on the news, it's about the geopolitical tensions, right? This is a view from our side, and it's about the sentiment of locations, right? And you see, for example, Iran, after the 1st of April, there was the attack of Israel in their embassy, and then you see that there was a negative talk on news. And that was the prelude then for Iran's response. I don't know, what are your thoughts about it? Do you worry a lot about geopolitics? Do you have any there's a microphone there, so if anyone wants to share their opinions. Any thoughts on that? Do you take geopolitics into account in your investing? Okay, let's see. No. So how many no's and how many yes? First, the yes. Who takes into account geopolitics in their investing? Nobody? It's one social. Do you want to share anything about what do you think and why you care about geopolitics?
We comment to content the microphone.
Yeah.
I think it can only help in scenarios where you're looking for something extremely cheap. I don't think it helps on the kind of base case scenarios, but like Turkey is a good example. For 2-3 years, it was quite cheap. I think still is. Brazil is a good example. What happened on back of the elections. In terms of whether a war happens, I think the research is like typically markets tend to ignore some of the conflict. Because companies still figure out a way to do business.
Mm-hmm. Yeah. Okay. Fair. That's fair. But what has happened here? I don't know if you can see well. Basically, we have the geopolitics, and currently, because it's the Middle East flare up, they affect the oil prices. And then the oil prices affect the inflation, and then the inflation affects the Fed's response. So you see that we had a long period of low interest rates. Then the interest rates increased before COVID, and then we had again zero interest during COVID, and when we wanted to support the economy. Then we increased the interest rate, and there was the anticipation that we will reduce them this year. But now the markets are tapping this one. Any thoughts on interest rates? If they can, the economy is robust, but if you think that Any thoughts on that, on interest rates, or how they can affect the economy? Or even the fact that now you can find bonds, or you can put your cash with some, significant interest that might be competitive to what stocks can do. Do you think of that?
Well, it's hard to say where the interest rates are going to go. As we were saying earlier, I mean, it depends. If the war goes on, if the oil price goes up, well, guess what? We'll have more inflation. The Fed's not going to cut interest rates. The longer interest rates, the longer the interest rates go on, higher for longer, they're calling it. The market will continue to have the volatility, and volatile market traditionally more bearish. So the challenge we're trying to predict where it's going to go is, well, nobody really knows what Iran's going to do, what Israel's going to do. So again, it's not worth the hassle predicting. You can't.
Anyone else?
Yeah.
Yes. No, just wanted to add. I agree that it's such a difficult, factor to basically build into the decision on what to do then in your stock buying or selling. My only consideration is that, notwithstanding the uncertainty, I have the perception that if I think probabilistically, perhaps a few months ago, it seems like there was more likely that there would be some interest rate decline this year. So I think the prices were building into that, and now I don't know. I feel that, again, anecdotally, based on what I'm reading, it looks a bit less likely. I think at least we're talking about 2 or 3 interest rate declines for 2024, and now they're saying perhaps no.
Maybe 2.
And obviously, if the oil prices, and if the oil price really creeps up, which I don't know, again, quite uncertain, but I don't see it at the moment because there's so much spare capacity in the other countries. So even if Iran really blows up everything, it might go ahead, but then for how long would it be before there's something from Saudi Arabia to increase, to tap on the spare capacity? So I don't know. But having said that, perhaps if I would do some day trading or some kind of short-term trading, I would be looking at these things, but that's not clearly part of my equation. As I don't know, the type of investor that I tend to buy and hold things. So maybe it's going to change the kind of ideal price at which I would buy, but how much it matters if I hold something for 3, 4, 5 years, I'm not sure.
I think just for me, the way I see it is obviously I don't know if interest rates are going to come down or no, but it does help me invest on the type of stocks I buy or I stay away from. So higher interest rates mean higher mortgages, means cost of debt is higher for people and companies. So people are going to be more cautious with the discretionary spending. So maybe stay clear of clothing retail or electronics or anything to do with buying stuff, household items, and then see what companies might benefit from the cost of living price. And if you really see one person McBride, it's an interesting one that actually benefits from that.
Yes. Yeah, it's points because even when you look at companies, you can look at their debt structure and their ratio between debt and equity. And if they have if they build up a lot of debt in low interest rate environments, then when they have to refinance that, they start to have long-term debt that becomes that they need to renegotiate. That can be a big problem. Usually that's tends to be trusted.
And when it exists for long, right? Because but now it may affect more and more companies.
Or they want to carry the debt on, so they will just renegotiate it and with the latest interest rates, depending of the premium they have to pay, depending on the quality of the company, etc. So that will have an impact, and also I'd say because it's the interest-free the risk-free interest rate, you tend to want to have a company that will, have at least an earning yield or successful yield that is higher than that risk-free rate. Otherwise, what was the point?
Yeah. Because that's how, mining the same returns, let's say. Yeah. Anyone else? Want anything? Anyways. And this is also the Federal Reserve balance sheet. So yeah, you see also that the tightening also agrees with the shrinking of the balance sheet. Now, this is our new site and tool. It's DCSC and it's a classification system. So later on, we will have a presentation from Ilias about the Magnificent Seven. And one of the tools of this classification tool is of this classification tool is that you can put your stocks and it can tell you where they belong. And the innovation here is that, let's say you take Amazon, right? And Amazon does 100 different things. They might be classified in traditional classification systems as retail. But here, every stock, every company is having a relation with a segment. So you can try it out. Then, let's say if you put the stocks of your portfolio, you can create a similar portfolio that can let you discover similar stocks. So you can visit DCSC and try those tools. And now I will pass the baton to Ilias. But before that, I want to ask you about how you feel right now, because the stock market has gone a bit down. How do you feel? I will tell you my opinion. Mostly, I feel neutral most of the time. But if anyone wants to tell their opinions, how they feel about the conditions, about the market, about the valuations, feel free to talk. Okay. So, Ilias, the stage is yours. Just that I will pass your.
Well,
Just wait for a second.
we can
Just to put your.
So the presentation I made is really very much a support, so we can have a bit of a conversation together. So let's start actually just by talk with everyone about what's your opinion about all those companies, those 7 companies, and do you think there is any value?
Yes, just 1 second, okay? You have also this one.
Okay. In Lydia, I mean, which one do you think is the cheapest stock in there?
Google.
You would say Google?
Yeah.
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 Yeah. No one wants to say that Tesla is quite bad at the moment. Yeah. Yeah. Yeah, I mean, the same. Nvidia is a bit of a weird one. When we will get into the see that they made really a lot of money, but you don't know if it's going to last forever or it's going to carry on growing like that. So yeah, otherwise Microsoft, Amazon, no, Meta, maybe some people say that Meta is highly play at the moment. So what would you say is the difference maybe between Meta and Google at the moment?
Slightly more expensive, but better management.
So Google is better managed. So Meta is better managed. Yeah.
Terribly managed.
Really? Oh, okay. So where is the critical part?
They invested more than anyone else in AI,
Right. Yeah.
and they have all those problems.
Yeah.
I think it's, yeah.
So actually on that, well, last time we talked about a podcast for those who were here last time, Lex Friedman podcast with Peter Hackman. And so Peter Hackman during the podcast talks about Google quite a lot. And also, well, that's the last slide, but we'll get back to that a little bit later. And was also saying that in terms of PR, Google had to be more careful when they release an AI product because they're not allowed to make a mistake considering the scale of the product and how much they're used by everyone. So it was a bit his explanation, and he was also very much on that side of Google as well, because I think he's part of their management board. This is a quick update of the stock I analyzed last time. So back then the stock was around 450 pence, and it crashed to 290. Honestly, maybe a week or two after the presentation, mostly because of their guidelines in terms of revenue for this year. So it was supposed to be around 180 million per year, and they dropped it to 155. So that is going to impact the earning per shares, and it's going to reduce by 50% the earning per shares. So of course, it changes a bit the equation, but that's why I also kept quite conservative numbers, because if they can make up for that revenue loss of the long term, well, maybe for holding stocks for long term, it could be interesting. And they still have a dividend. I don't know if they're going to slash that at some point or not, but it will be interesting to see how it goes. So
Does it work?
Yeah.
Now?
Yeah. Yeah. So, Magnificent Seven. Well, they're not the top 7 companies, and they're not really magnificent anymore. It's just interesting to see what's their market cap as of today. The top 4 now, Nvidia's market cap is bigger than Google at the moment, and Tesla is actually way further down. It's not even in the trillion market cap club anymore. So this is just to say that everyone is aware of the hyper concentration of the top stocks in the S&P 500. That's still this chart is still relevant, even if it's from January. And so I wanted to look at their price to free cash flow and compare the average price to free cash flow that they had in the last 5 years and what do we have today. So, for example, you would think that, okay, Tesla has always been a crazy valuation and had a very big price to free cash flow. But actually, if you look on average over the last 5 years, they've been profitable. Actually, the price to free cash flow that we have right now is it's almost 120. The cheapest ones that I could find are really just Meta, Alphabet, and Apple, and they're around close to their average between around 25. So if you cover that just to look at it from a yield perspective, free cash flow yield, none of them are above what T-bills are giving you at the moment. They're all below 5.4%. So if you look at both the free cash flow yield in blue or the earning yield, so just earnings per share, the net incomes of the company, they are all quite low at the moment. So there's a lot of growth priced in. And I thought it would be interesting just to look at, let's say this is a fair assumption. Let's say the market is right and we should have this valuation. What does it mean in terms of end value? We look at the growth over the next 5 years. and what would the companies need to achieve for that. So there's way too many numbers on this slide. I should have split it in half, but that's so my assumptions were to say, well, you want a 10% return per year over the next 5 years, and you want to then sell, and the end multiple will be 25 times the price to free cash flow for the stock, just to put them on the common. At the beginning, I used the average, but then it was a bit disparate from the stocks. So, I mean, to have a 10% returns year over year for the next 5 years, you would need to have Tesla delivering over a 50%, like around 50% free cash flow growth for the next 5 years consistently. And yeah. And then, same for, and even for NVIDIA, that would be around 38%, 30% for Amazon, 27% for Microsoft. And then the three at the bottom, which have the most conservative numbers, are Meta, Alphabet, and Apple, with around 12% free cash flow growth. So we can say, okay, well, those three companies are potentially the ones that have the fairest value of the seven. But then it's a bit hard to distinguish those three. Why, if you had to pick just one stock, which one would you invest in, basically? And the thing is that when I looked at it, well, Meta's number and Google's number are very, very similar. In terms of debts, they have absolutely no debt, or maybe a few millions, but it's less than 1% of their assets. Whereas if you compare for Apple, I didn't know that, but their debt situation is actually quite different than it was 5 years ago. So now Apple is, I think, over 100 billion in debt. So of course they have a lot of cash, but even their current ratio, even their they can't cover their debt with their cash at the moment, which used to be the case before. So when I try to distinguish the three, they also have big rates of buybacks. So they buy. I think for Meta and Google, again, it's about the same. I think it's 17 billion per year for Google and 20 billion per year for Meta for buybacks. So you can really distinguish them on that. And for the future growth as well, that has been that you can see on the analysts. It's only Google and Meta have above 10%, and same again, very similar growth around forecast growth of earnings around 12 or 13%. So I really struggle to split the two, to say which one is actually has the most value at the moment. The only thing that I could find as a big difference between Alphabet and Meta at the moment is that there's a lot of insider selling with Meta happening in February, whereas no one is currently selling.
Lots of insider selling in Meta.
Yeah. And in Meta and Apple, there's been a lot of I couldn't find anything on that. So yeah, I was trying to find the numbers on this, but that's all I had. It was just to have a bit of an introduction, a bit of an update on this topic that was a lot on the news, and now was a bit out of fashion, but it's good to see actually how those valuations are changing all the time.
So how do you feel about the Magnificent Seven? Let's make it like
let's talk
or
about
participate about it, and stocks of those that you believe that they are expensive, or
Actually, your price to free cash flow.
this one.
Yeah.
Yeah. So I took up to 2023, and then 2024, 25, 26, 27, all of that is estimates. No. Those are free cash flow growth based on on my need to have a 10% return on year over year for 5 years. Yeah.
So it's around.
Yeah.
And
So this is just numbers, calculation, and those are a full fiscal year. Because even on that, some of them started their fiscal year 2024. So I removed that and just kept 2023. But for example, I mean, you see, like for example, Amazon, they were negative for 2 years. Even if we think that Tesla is a big company, and even if they deliver 50% growth, they will not even reach the cash flow that's Nvidia delivered in 2023. So yeah, that's interesting.
The other side was really
But
interesting.
you can take them the microphone if you want. If you want to say something extended.
The other slide, when you compared the 5 years, I think that was brilliant.
Yeah.
Because we
Yeah,
realized
this
they
one.
were all very expensive.
Yeah.
They all above the 5-year free cash flow.
Yeah, they're all above their average. So you have to, I mean, they need to deliver a lot of growth to justify those valuations today, and then have the average cash flow of next year that would put it back to the average. Yeah.
The only thing I would say, there is some of them that started to focus on cash flow. So Amazon started to focus on cash flow.
Right.
Meta as well. Alphabet has it. It's the only one who's not firing people, for example.
Yeah.
Okay, they decided.
Yeah.
Probably the stock will
Yeah.
increase a lot.
Yeah. Yeah. And so that's why even there, I also took the net, where was it? Sorry. Yeah, the net earnings as well. Just the inverse of the price earning ratio. And, but yeah, it seems consistent between, except for Tesla. I didn't look at it further why there is such a difference in cash flow, in free cash flow for Tesla and the price earning ratio. But, yeah.
We're still investing and then the bottom of the cycle. This is why we're still building factories everywhere. I guess.
Yes, so they invest a lot.
This is what happened with Amazon.
Yeah, they have a lot of capital expenditures.
I think all business.
Yeah.
From those stocks, which you think either because of their growth prospect or because of their relatively not so excessive valuation, which are the stocks that you believe in, and which are the stocks, you believe that they are the worst? Yeah, you can all talk about that, right? And which are the ones that you're afraid the most, either because of valuation or of bad prospects, and you can all talk about that. Yeah.
Well, I was going to say, I was going to agree with what you said about the difference between Facebook and Alphabet, and that the management of Facebook on their shareholder focused. If Google turned around,
The microphone a bit closer.
if Google or Alphabet, if the management turned around and got rid of the bloats, the number of employees were more efficient, I think they would explode. And then you have to think about what's inside Alphabet. Things like YouTube. So that's the biggest streamer. Low key is the biggest streamer in the world. And so that free cash flow, when it starts making a huge significance to the bottom line, I think Alphabet probably is the cheapest bet.
Yeah. Yeah, and also Meta, maybe they got scared a bit with what happened to their stock in 2022 and shifted their attention towards investor more than investments.
What I'm afraid
I
of.
don't,
You go on, go.
sorry, I don't follow those stocks very closely, to be honest. The one I'm a bit worried about is Tesla, because the way I see it is, they were the first one to really go electric cars, and then you see competition, picking up, coming up with a very competitive cars, SUVs, and all that sort of thing. So it's definitely probably one I would say is feeling the heat, and then when you have a CEO that's such a superstar and all that, brings all that attention. I'm always a bit worried about that. It's that's all the personalities as well.
With how many billions of payout that Mr. Musk won Yeah, so it's, and
Jordy?
that raises the question about how much does a shareholder gonna be cared for? This is,
Yes.
So
Yeah.
I looked at this Max 7 quite a bit actually. So here's a pop quiz question for all of you. If you were holding Max 7 as a stock, single stock, then over a 2-year period, last 2 calendar years, 22 and 23, how much you would have earned on the stock? Any guesses?
Sorry, can you?
If Max 7 was a single stock
Yeah,
and you bought it on 1st of January 22
yeah.
and you held it till end of December 23 for 2 years, how much you would have earned?
In returns?
Yeah.
Honestly, I'd say,
Any guesses? Like
50%. You said.
70%? 15? Any other? 100, 100%?
Yeah, or
So,
150.
You go and check this. The answer is 2.7% per annum.
Oh, right.
Yeah. So the only stock that actually delivered it, like 2 stocks delivered positive returns. Nvidia was about 25% per annum between 22 and 23.
Yeah.
4 of the stocks were negative, and I think Microsoft was 6% per annum.
Mm-hmm.
And I think the point is that at the beginning of 22, the multiples were very high, and then they corrected, right? And I think we are back to similar sort of, at least at the beginning of the year, we're back like 34. If you Max 7 is a single stock, you're looking at like 34 PE.
Yeah.
And so, best case, we are looking at next 5 years, maybe 5-6% per annum as a single stock, I would think. Now, within that, you will have some which will do well, and maybe some like Tesla which will go down. But it's an interesting exercise to see, like, when you showed the first chart, it showed the concentration dropping.
Yeah.
It was also a
Yes.
lot of these stocks were negative in 22, right?
Mm. So yeah, maybe it's going to be another cycle of oil and gas. Come microphone, please, if you. So maybe we're just before another cycle of tech stock sell-off and oil and gas with tensions with Iran. It's going to go on.
so the fundamental question is, where is the
Yes. Yeah.
which of these stocks is actually going to have growth?
Yes. Yeah. Yeah.
Because with Tesla, one of the other problems, I've never looked at any of them actually, but just speaking theoretically,
Mm-hmm.
with the EVs, my perception is that everybody who wanted an EV's already got it.
Yeah.
And the others are waiting for infrastructure to get built. That man, you have not yet Scotland finally. That'll probably get started. With Apple, how many more iPhones are you gonna sell?
So yeah, that's actually quite interesting because if you look at Apple, so the first one in blue, they already had a quite high cash flow back in 2020, and they've been sort of flat sitting around 100 billion, 100 billion of free cash flow per year. And the variation that you see, for example, here or here, are mostly due to their capital expenditures. But if you look at cash flow from operations, they've been above 100 billion since 2020. So they don't deliver much. They haven't been delivering much growth in the last 3 or 4 years. Whereas for Alphabet and Meta, so of course Meta had a bit of a difficult year in 2022, but they've been growing a bit more, and also if you look at the latest quarterly reports and you take the trailing 12 months instead of the full fiscal year, they're already hitting my estimate of 2024.
Go. Because if I look at these 7, and again, I haven't looked at the numbers for any of them. Amazon probably entering into pretty much every business. The last time I looked many years ago, I think the margins were very thin.
So yeah, Amazon is the one in purple. Yeah.
And which I suspect is probably a bit deliberate, to be honest, because they invest and they don't like to show profit.
Yes.
Google and Meta, I'm less convinced personally. Because again, advertising revenue, all the AI type stuff, manipulating people's mind. I mean, all the ML that's already been done, machine learning type stuff has already been done. Generative AI probably will take longer to actually show any benefits. The ones that I'm more convinced about is probably two, NVIDIA and Microsoft. And the reason I'm more convinced about them is because the likes of Amazon and Microsoft are putting a lot of investment building platforms which require generative AI type things. Now, generative AI is not going to show results tomorrow, but because they put a lot of money to invest, and they're trying to build platforms which require NVIDIA stuff. Microsoft and NVIDIA is more likely to do well. A lot of the banks, major institutions, when they need to sort of experiment with Gen AI or cloud or whatever else, they'll probably go to Microsoft, they'll probably go to Amazon. And that's probably the value chain where they may be. And again, I think at the moment we're in a hype phase. There is a possibility we get beyond the hype and it all crashes. And I think my gut feel is in the shorter term, we are overestimating the value Gen AI will bring. And in the longer term, probably we are underestimating.
Because this is a great overview, I find. I mean, it's very good to see it like that. The thing that I wanted to point out here, though, is that if we say that Microsoft is going to be there and it's going to deliver, and NVIDIA is going to be there, they're going to deliver. If you just want to have a 10% return on your stock and on your purchase with today's valuation, Microsoft will need to deliver around 200 billion of free cash flow by 2028. There's no company currently able of doing that. And it will end up being the biggest valuation, and for NVIDIA, they will have a similar challenge. They will need to deliver more free cash flow than what Apple is doing today. So the question is, do we think that they can do it? I don't think they can do it at those valuations. The price will need to drop to justify a purchase of those, great companies with a good moat. So,
any other opinions? I have also something to add. Okay.
take the microphone.
Okay. So, on a high level, what makes me okay? There are the valuations that are a bit high, but then I think that those companies erupted because you had a period of technological revolution, then the internet. So they went through those ways. Probably Microsoft much earlier, but the other companies they were through the internet. And I think now we have a new wave because of generated AI. Because I will agree with you, because sometimes we may overestimate the short term, but we underestimate the long term. So if we are in a new cycle, if you see the history, every new cycle, when you have a new great innovation, you will have another 10 companies. Maybe only one or two of them will survive. So something that I just want to comment is that about Tesla, I don't like the valuation. I know they let's say have a lot of competition from China. But what I like from Tesla is that they managed to get there by having a small size, and nobody could do that in 100 years. So now that they have this size, something is in their DNA, and that's what makes me feel that Tesla might survive and might flourish. But I don't like the valuation. Yeah, so that's what I think. Well, other opinions?
I agree with everything that's been said so far. The way I'm looking at this then is starting from really first principle, what's the competitive advantage of these companies? And I tend to agree with what has been said so far. Tesla seems the one that, I don't know, where I see, where I could more easily, even just as a consumer, say, how many people can compete with those. And so, could easily find a substitute. And I feel there's been a lot of hype also related with this climate thing. Tesla was a bit of a lifestyle stock. And so if I would place it in an ideal quadrant, valuation seems like the most difficult one to justify, and the one with the weakest price competitive advantage. So I really struggle there to justify a buy. If I would go one step up, I don't know, all these companies seems really fine companies. As you say, it's really like at what price I would buy them, because they all look like companies that, if I would place a bet, I doubt that any of this company would be completely bankrupt in 5 or 10 years. And I agree with a lot of what has been said about Microsoft and Nvidia, although as your chart really eloquently shows, the valuation are pretty much crazy. I mean, I like your way of thinking, this kind of reverse engineering, what it takes to justify the kind of valuation. And I struggle, although I don't know if I would be really definitely looking very closely at what's going to happen in the coming ones. And Alphabet, I don't know why. I mean, again, I'm not an expert, but I own Alphabet, and I don't know. It's one of those that, irrespective of all the difficulties, it seems to me that given the valuation, what you've shown seems the least risky one. Although I wouldn't be surprised if things could go in the wrong direction, at least in the short term. It depends also on the horizon you can see that.
So yeah, I mean, basically, yeah, if there is a big sell-off of those stocks, the one at the top of the list are definitely the ones I would start with, like Apple, Alphabet, Meta, and then if the sell-off carries on, well, maybe it would be a good entry price for Microsoft, or just use that as a basis to see also what all the growth estimates and actually maybe some of them are actually fair valuations at all.
So we have a comment from the live stream. So Theodoros says short Netflix, short Nvidia and Boeing, and long UK and EMEA. So yeah, so other people that they listen to us live, they can also post your questions. I mean, we can take 1, 2 more, and then we can move to the next presentation if anyone has any more to comment on those. So we go to the next one?
Yes.
Okay, yeah.
So I've been sitting quiet because I have no really strong opinions in terms of what they're gonna do in the next 5 years. I'm just curious, anyone would like to take a bet, which one of those will still be around in 30 years?
In 30 years. So it's exactly 20, what the long fund will be around.
Yeah. We have a microphone.
The world will stop working if Microsoft.
I mean, it's true that they're good with acquisitions, and they became stronger and stronger over the years. So
I would say Amazon actually.
yeah,
They have the warehouses and so on. Microsoft, they have software and instructed. I don't think warehouses all around the globe. Good luck. You have the same network and logistics and so on.
We have one for Microsoft, one for Amazon.
right.
Feeling that Amazon will go the very standard order. They will get broken out.
Right. Yeah. There's always that risk. Yeah. It's true that for American companies they have.
Warehouse, you need to have so if somebody finds an
From Brazil.
So the fact that they have heavy physical infrastructures, it means that they have high fixed costs. And if somebody comes up with a alternative business model, it's very high to reduce the cost for travel. So there's that risk. Microsoft is an infrastructure risk in every company. It's very hard to replace it.
So if you have a software RIS, it's really exactly like Excel, and it's straight. it might change.
Yeah, it's a company that run it on.
Honestly,
hard
you wrote this.
In theory, yes.
No, it's in the
Well,
streets.
Apple came up with, what was
Microphone plays.
Apple did come up with their own version of Word, Excel, whatever else.
Didn't take, didn't take all that.
It didn't quite take over.
It's true, but Google has it as well. I'm not it didn't take over, but I think someone could do it in the future. Whereas if you have physical things, it's much harder to replicate, I think, compared to software. That's my point, especially with AI. Now AI can code everything for you.
Yeah, I haven't looked at Amazon's numbers, but because Amazon's only business is not retail, they are into the whole web.
Services another one as well.
I don't know how it's done, you know.
See, I mean, for Microsoft, it's been a while. Now Microsoft isn't just an Excel and a spreadsheet.
It's not much either.
Yeah.
Amazon is easy, the money is on the cloud, and they subsidize their retail business with it.
Right.
Again, the day they decide to make money on the retail, they're going to boost their cash crazy.
Maybe 30 years that Royal Mail is going to disrupt. As it varies.
Do you have any closing comments? Because
Yeah. No, I can't wait to see in 30 years' time Royal Mail taking over and and also see Yahoo Finance articles is Apple the new IBM stuff. So yeah, but yeah, thank you guys for your attention.
okay, so give me just a minute. Right.
Yeah.
So we have with us, let me just say a few words for you. We have Gaël Umano,
Yeah.
who's gonna present McBride.
Yes.
So you have experience of 15 years in analysis and stocks, and you write the right stock at the right price, right? Is that true? Oh, sorry, you can say. Oh, no. Yeah, you can say more about me.
Okay, no, thank you. No, so to do my job, I have to analyze companies every day, sometimes private, sometimes public. And I came across McBride a few months ago, never heard of them either. And I wanted to talk about them because they are one of the best turnaround stories I've ever seen in a long time from all the companies I've been analyzing. So let me just go through the story, the recent story. And then at the end, you can tell me if you like it or not, and we can share this. So you probably wonder, what do they do? First question. So they do cleaning products. Yeah, I know, not very sexy. Moving from the Magnificent Seven to cleaning product companies. But more specifically, they do private label cleaning products. So that means if you go to, say, Tesco, you want to buy a dishwasher tablet. So you have the well-known brands, but then next to it, you have the Tesco brand. But Tesco doesn't actually make those tablets. It contracts with someone like McBride. I'll say, hey, McBride, can you make for me dishwasher tablets or bleach or soap? McBride said, I can do that for you. They enter into contracts, and then they just put the product into the eyes of the Tesco supermarkets. The only difference really with branded products is they invest zero in marketing. So there's nothing spent on advertising, no marketing. You just go into the supermarket and you see the Mr. Muscle brand, it's like £4. And you see the brand you never heard of before next, or the Tesco brand, £2. I don't know. That's very much everything I want. So they are a member of the FTSE Small Cap Index, in here. They've been around for 100 years. And I just wanted to put the number of employees because it's 3,000 staff. So for small cap companies, actually decent size. So that's just the slide used to explain how they are divided. So you can see they have 5 divisions. By far, the biggest one is the liquids divisions, which is about 56, I think, % of their revenue. And then unit dosing, powders, aerosols. And then the last one is Asia Pacific. So McBride, they are one of the leaders in Europe. So Western Europe is the biggest market by far. They have contracts with 90% of retailers in Europe. So for some of them, they're going to do just liquids. For others, they will do just powders. For others, they will do the whole thing. It's only been a few years that they're expanding into Malaysia, Vietnam, and also Australia. So you can see Asia Pacific is tiny, but flexible and as you can see, the performance, operating profits is not so great. Loss making, break even. Liquids, despite being the biggest one, is not making more money than unit building, so it's not very exciting. So when I reviewed them, I saw their June 23 full year figures, and it looks like that in a nutshell. So you can see June 22, it was bad, but really bad. You see adjusted EBITDA negative, big operating loss, big net loss, a lot of debt, and so on. And then the release June 23, still losing money, but getting a bit better, Sales are up, EBITDA is now positive, operating profit is profit, but they still lose money. Their total equity is really low, the debt is high, and the liquidity, which are always something I like to pay attention to, was getting tight, to be fair, like 59 million of cash plus headroom in the RCF. So they have an RCF of 175 million euros, but they were using a lot of it to have only 59 million left of liquidity. Net debt cover ratio 2.9. So not great, still not interesting, but actually, improving clearly. And then I thought, okay, I'll wait for the November trading update. And then what happened is they released something for him in October. And usually, from my experience, that's usually a bad sign. That's probably warning. Management team saying it's not going as expected. It's going to go down. But October, they say the following: continued effect of cost of living crisis means basically more consumers who want to buy private label products. Guess why? Because it's cheaper. So our sales in the first quarter, so July to September, is going to be up 10%. Wow, okay. And then we think our EBITDA is going to be £8 million ahead of our internal forecast. Wow, okay, interesting. Anyway, I wait for the next update, the next month. And that's what they say. Again, continue the consumer shift towards private label. Now we think our volumes are up 11%. And by the way, we think that our net debt to EBITDA is going to be around 2 times. If you remember the previous slide, it was 2.9 times. So from how I analyze companies, I'm like, well, that's if they really achieve 2 times, go from nearly 3 to 2 times, that's a nice quick change in the. So that's why I bought some shares. I thought, okay, I need to buy some shares. So then nothing happened for a few months, and then February, they released their half-year figures to December. And again, I look at it, and that's just a snapshot of the report, and I mean, look at that. Everything is much better. Suddenly, the sales are up 10%, operating profit is up 30%. They now make a small bottom line net fit. So they've really turned around their the performance in just 6 months. Net debt which was really high, has come down, still fairly high, but anyways, it's improving. And another thing I like to look at as well is when they release this report, I just see there's any comment from the management team, what do they say about the outlook, guidance, and that's what they say. Very optimistic, should we say. We feel like the demand level we've seen in the early month of 2024 is going to carry on through 2024 for private labels. We want new contracts, okay, right, with other supermarkets. That's going to improve sales in the second half of 2024. And then inflation is still an issue, it's still there, there's cost, so yeah, like a lot of business, of course. But our operating profit is now going to be 10 to 15% ahead of what the management expected. And by the way, our net debt to EBITDA is now definitely going to be below 2 times. So wow, okay, interesting. So yeah, very bullish, positive outlook from the management team. So you probably wonder, how did the share price react? The answer is very well. It's up 250% year on year, and it's up just 30% since January. To be honest, you have to be a bit crazy to buy here, because the company was close to bankruptcy. Honestly, it was really, really in a bad shape. It was distressed. And despite all those positive news, my opinion is that it's still fairly, still nicely priced, because you see the market cap, 191 million, and PE ratio, 10. I like those numbers. That's because the way the train is going, McBride is going to turn around $1 billion sales by June 24. The EBITDA is going to be about 80 million. So to have a market cap of 190 million, that's low for a business that's going to generate nice EBITDA. So so I thought, okay, let me see what the competitors are doing, because obviously they compete. They're not the only ones making cleaning products. You've probably heard of these companies before: Unilever, P&G, Reckitt. They're all listed, so they all publish a lot of information. And it's interesting that those giants are actually a bit struggling, at the moment. So Unilever, it was clear that in Europe they lose market share to private labels. Okay, interesting. Reckitt, the share price completely collapsed. Not so much because the sales were down a bit, but they have a product called baby formula that they sell in the US. Then the baby died in the US after being fed through this formula. So the company is being sued in the US. It doesn't look so good. Investors are really scared. And even P&G, the mighty P&G for me, which is like, highly profitable business, a lot of cash, a lot of strong balance sheet. They're not actually selling more. If their sales are going up, which is by 3%, they say because they increase the price of the products. They don't actually have a higher volume of products being sold. So they're not really getting market shares. That's what I'm thinking when I saw those big guys flat or going down. Next to them, you have McBride, who is sure a smaller player, but showing a very strong growth in revenue and profits. So it's all positive. So I thought, I like when I try to get a nice story about it. So I want to get see the pros, also the cons. I don't want to think just about the positive or just about the negative. So it's my last slide just to go through the what I think are the pros and the cons. So first pro for me is boring. Love it. I love the company. I'm sorry if someone here works in the cleaning product industry. I don't mean in a bad way, but I love a company that makes something easy to understand. It's pretty straightforward as a business, but also like the fact that they are on the small cap, so no one really cares about. No one really pays attention like much bigger stocks or much bigger companies. There's no institutional investors behind it. There's no brokers telling you to sell or hold or buy. So it's just minding its own business, and I like that. financial performance, as we go through, is improving really quickly for me in a good way. Short-term outlook, as we see it, positive. So it looks like private label is having a good time. And to me, of course, that's just my humble opinion. Despite the share price going up about 30% or 250% year on year, because it went from such a low base, obviously it makes sense for the share price to go up. I think it still has potential to go further higher because when they're going to release the figures in June 24, the numbers are going to be good. It's obvious, you see the half-year figures, really good. The outlook looks really good as well. So unless there's a really big unforeseen event, it's gonna, the figures should be good, and usually that means share price goes up. On the cons, no dividends. So look for a dividend stock, don't buy that one. That's the wrong one. They don't pay dividend for two main reasons. One, the management say we want to keep the money to reduce our debt, invest in the business, capex, which I think is fairly sensible as a decision. Reason two why they don't pay dividends is because they're not allowed to pay dividends. So if you read their annual report, when they refinance their RCF 2022, the bank say, okay, we refinance McBride, but the condition is no dividends until the RCF expires, which is in 2026. So I'm okay with that personally because I like to buy stocks where I think that the story is good and the share price is going to go up. If it pays on dividend, great. If it doesn't pay dividend, that's okay. On the cons as well, the balance sheet is, still weak. I would say, the equity is low, so it's not, the blue chip business, multi-billion-dollar type of a balance sheet. No, it's a fairly small balance sheet. They've been losing money for a long time before, so that really impacted their equity and so on. They do compete with much larger companies that we've seen. So you never know, maybe those companies could reduce the price of the products to really harm someone like McBride. Don't think they would do that. They're not really into that type of compete on the margins. P&G, for instance, they really like to keep the margins where they are. If they start reducing it, then impact the share price and so on and so on. So it's not really, I think, what they would do anytime soon. And then another thing is, I don't know how long the private label trend will continue. It's obviously there's a sort of cost of living crisis at the moment. So what if once interest rate come down and inflation remains low, people will have a bit more money in their pocket. So does that mean that we shift back towards slightly more expensive branded products? Probably yes, some of them. But I guess other people would just stay with the private label. You know what? I like it. It's same quality. It's cheaper, so I'll stick with it. So that was it, really. Just let me know what you think. I know it's not for everyone, but it's definitely. I never thought I would get so excited about a cleaning product company. In my 15 years of analysis companies, I must say this is a really nice turnaround story. And at least on the short term, it looks rather good.
Yeah. So we now can take questions, yeah? Please, Master Mark, that would be.
Sorry, you didn't tell us the most interesting part. What do you think is what? Where is it gonna go? How high is it gonna go?
Yeah, I don't know. When I saw the share price, I thought I'd be happy, if it reached £1, I said. And then it went to £1.20. I was like, I'm not going to keep it. No, I like it. I like keeping it. And I was looking back, how high the share price went back in 2017 or before they went into trouble. It was like £2, the one share. So you could think, to me, I could see the stock going up far more because usually, the rule, as we probably know, is when the company does well, when the news are positive, share price goes up. When a company doesn't do as well as expected, then share price tends to go down. So this company so far have, at least recently, has only been posting positive updates. And the way I see it is going to carry on, at least on the short term. No?
And do you know what was their revenue or EBITDA back in 2017? Did you get access to those numbers?
I'm sorry, no.
I just have a question, but it's just what is exactly the total equity? Can you just explain that to me, because I'm not.
Yeah, that's the advantage. That's basically what we call the shareholders fund. So the share capital plus P&L reserve.
Okay.
So that, obviously they lose money, so that goes down, goes down, goes down. So it was like 35 million pounds, I think. So now you can back up because see the make profit, so it feeds through the balance sheet.
Right. So the debt is putting that down, or
No. That's
okay.
That's the can explain. You should the balance sheet if it's just you have the debt, and at the bottom typically at the bottom you have the shareholders funds. That's what I mean by
I have a question. Do you know where they're going to grow? So where is it coming from? Is Asia going to take over? Because it's very small. I think it's like 5% of the revenue. Is it what you see as the future then?
No, I'd say it's definitely Asia is tiny for them, so it will help them, because it's nice margins actually for the size of the business in Asia. But it's not what is driving the recovery. It's really Europe. It's the fact that they win more business in Europe. So it's France, Germany, UK, Poland, Benelux, a bit of Spain as well. And it's volume, So it's not just winning more contracts. It's just selling more than before. There's just more people who are happy to switch from the brand, big brands, to the brands we never heard of before, but they're cheaper, so that's what people buy. It's cleaning products, right? So we all use cleaning products. We all use soap and dishwasher tablets or powders. Everyone has to buy one. So just which one do you buy, and what is the cost of living prices? You know what? I don't mind buying the brand I never heard of, but it's cheaper.
What did you think about the management itself? Do you think they're trustworthy? And what's the ownership structure? Is there any founder who still owns the company, or is it just all?
No, the company was 100 years ago, so the company Mr. McBride is still around, but the CEO is Chris Smith, so he joined in 2020. So during the crisis, when the company was really in big trouble, so he set up those 5 divisions that you've seen. He said, okay, we need to be more organized, more structured. It's going to help us with our contracts. And then in 2022, McBride was really badly impacted by inflation, but the cost rising. And the problem was they were in those fixed contracts with the supermarkets, so they couldn't pass those costs to the likes of Tesco or Carrefour, because they were stuck in this contract. So, they were basically forced to produce those same products and lose money on it. So now you can see in the reports, they say now every contract that they have, they're disclosed to say any inflationary costs can be passed by McBride to the supermarket. So that's why he's helping them as well to make sure they don't get into contract and then lose money on the contract. It has to be.
Somebody who hasn't talked yet and would like to speak for the first time.
Yeah, thank you very much. Just to clarify, got it right? It's a contractual manufacturer, like 100%, no its own brands, right?
Correct.
Okay. Just understand this right, this last cons that you highlighted that people will not be buying like private labels due to inflation or due to other reasons. To me, it's like you think just to understand. You relate this turnaround to inflation, and if it, let's say, persists this year or next year, then this turnaround will be intact, will be accelerated, or do you think it's like some trend of shifting to private labels that is like long-term trend, and they will benefit even if inflation is slow? So it's just. Yeah.
Yeah, I think they will. I think they still benefit from it. It's a bit. To me, they make me think about Lidl or Aldi. You know, where people in the past we didn't want to shop in Lidl or Aldi because bad reputation or it's too cheap, and then some people start to go in there and realize oh, it's not too bad. So they start to get used to buy into the likes of Aldi and Lidl, and they don't mind going there, buying the cheaper version of Nutella or big brands that you have there. And now, the more they shop the same products, the more they get used to it, and the more likely they will just carry on doing this, even if these cost of living crisis stops or inflation go down, or interest rate go down. I think they will still, not all of them, sure, some people will probably switch back, but I think majority will still be, because they will be used to it, stick to that sort of product.
Yeah, so probably one more competition because you mentioned P&G, Unilever, but this is like branded products. I mean, probably they are not like direct competitors. I mean, probably there are companies who also contractual manufacturer to Lidl to others. So like the direct competitors. Do you think McBride is like low cost competitor? I mean, are they able to manufacture these private labels like at like reasonably low cost compared to others? Yes.
Yeah, I think they clearly have a. When you go through the annual report, you can see how many factories they have, employees, and they have factories in Asia, factories in Europe. It's quite a handy in terms of the factory and the fixed assets that they have, because it's obviously it's physical products that they produce, and that's the only thing they do. So they just do that. It's not like someone like Unilever, they do clean products, they do ice creams, they do so many things. P&G the same. It's just basically brands that they advertise and then hopefully sell for as many as they can. And
Are there any, so a quick one. Are there any modes, anything like any modes? I mean, something that modes, I mean, it could be like they can compete in cost. Let's say they are the low cost producer. They have something that they cannot, because if they're commoditized and you have this success and they get some good margins, right? Then another one can copy them, or they can come there and do the same thing. If it's something that they can differentiate them, in a way. So it's not a commoditized business, so they can keep some better margins. If you can think of some.
yeah, no, it's a good point because I don't really know if there's another publicly listed company that does exactly the same as McBride in terms of the pure high level product. I haven't looked at it really, but to be honest, I'm not sure there is. Still listed in London. I'm sure there is companies out there that do it. It's just they're probably privately owned, and so it's harder to get information. But for Europe, McBride is clearly, Western Europe at least, by far the market leader.
Is any brand value that can they recognize this private label products? Okay, they are cheap, but they are good. Is it any value there? Let's say sometimes they might be like, we know that this product is not so well known, but it does the job. So do they have any brand value in some essence? If it's private,
no, yeah, it's they invest zero in brands, but obviously you can see on the products they sell, they have brand name. Obviously, you would never see that brand in a TV or TV ad or in the billboard. It's just not advertising. It's just the business model of a private label product.
I would have thought that if they're a private label, brand doesn't really matter. I think the key thing is they need to be the lowest cost producer. The question is, are they? And I think what you're saying is they are, because you couldn't find any publicly listed company. If there are other producers who can produce the same powders and stuff cheaper, then obviously that's a risk. But if there aren't any and they're in competition with the big brands, and that's works. But I think that's probably, I don't think they would spend any money on building brand if it's one.
No, and the other way around, Unilever did it's an interesting article by Unilever to say, so one of the analysts on the call, what they reported their figures was, so you raise market share to private labels, are you going to pick the prices? And the CEO of Unilever said, no, we're not into the low margin business. We have brands, we want to keep our margin high. We want to create new brands, we want to create new markets. So it's a very different type of mindset. P&G, they spend billions on the brands, they spend hundreds of billions on ads just to make sure it's seen as the best quality and so on. McBride has the complete opposite agreement. It's just, but in a way, it's like a guaranteed contract, because they enter the contract directly with the supermarket and say, okay, for you, Tesco, or for you, Sainsbury's, I do this, I do that. All you have to do is pay me this and so on. So it's quite a nice business model when you think about it.
Do they say anything on your report how they are the lowest cost? And is it because they've got factories in cheap locations? Are they very operationally efficient?
Yeah, I don't know. I mean, it's a mixture of, they have factories in Asia, so that I'm guessing that helps, but it's also they have factories close to their clients as well, close to the supermarkets that they distribute to. So in terms of a supply chain cost or logistics cost, it's obviously competitive. It's interesting because the biggest competitors actually, they don't really want to compete on price. They like the margins. The Cherry brands is gonna it's always gonna be more expensive than the McBride product because McBride want to be cheap. The Ariel want to be they're nice cash flow, nice margins.
I was thinking about the last point here on the first time. So there is, in my view, potentially a strong element of cyclicality in the consumer choices. So in the sales, have you considered a way to test the sensitivity of the sales to the consumer behavior? How cyclical can be this consumer behavior with the sales? So the historical comparison would be like 100 years, but I don't think you might have gone so far. But you might have like a geographical comparison. If they cover Europe, you might segment your research in different markets and see countries going through periods of lower weight purchasing powers by customers. How do customers behave in the shift of the consumer power when it increases? You might not need to go like 100 years. You can go like 5-10 years, go to Italy or Spain or UK. And that would be complex if you find a way to stress the sensitivity of the states to the shift. That would be one. And the second one would be, I saw that the last year in the income statement, there's a strong impact of financing costs. Okay, so what is the structure of debt maturity, and what impact has had increasing interest rates on the cost of debt?
Yeah, that's a good question. Yeah, so the refinancing in September 2022, and when they refinanced, they had I guess the banks were a bit greedy, and they charge on the 25 million, half of it was just refinancing costs to be able to refinance. The other half was actually just interest to pay. So those 25 million are for sure going to be lower for 2024 because they don't have refinancing costs anymore. That's been done 18 months ago now. So now all they have to do is make sure they pay down the debt. But they can easily do that now because they've clearly recovered in terms of margins and ability to generate cash flow.
Aziz?
Yeah, no, I was just thinking about it. I think because they are low cost, obviously that's a competitive advantage, but I think it also comes because these guys manufacture in Europe. And for a product which is kind of low in price, it's not easy. And something that has to be sold in Europe under EU regulations, it's not easy to get it manufactured in China and ship it, right? So think of like dishwasher tablets and think of like washing liquids, as you said. A competitor has to set up manufacturing units in China, right? The chemicals are the same, but then has to ship it and then distribute it to various locations and still follow EU regulations. So I think that's where their competitive advantage comes in, that they have those facilities. But at the same time, I think the growth would require them to put in more capital, right? If they have to sell more volumes, let's say because Aldi and Lidl start taking away more market share here across Europe, right, and start selling more private label, then by definition, it would need more volumes. And I guess my question was, do these guys have enough capacity to service growth for next 5 years, or will they have to put in more manufacturing facilities here in Europe, which will then drag down their returns on investment and return on assets, right? That could be a risk. Or because of that, they could be limited as to how much volume they could do.
Yeah, so they currently, just in Europe, they have contracts in place with 90% of the retailers. So I guess they win new contracts, not because for, say, Aldi, they currently do liquid soap, but then they win a contract to do also dishwasher powder, so and so on. But you can see they can't afford to take, they're not going to stretch themselves. No, their key priority is to make sure their performance is back on track. And then you can see the CEO, his priority as well is to reduce the debt that he thinks is too high. And then once they go through that step, stabilizing the business, strengthening the balance sheet, then I think, they will definitely think maybe more aggressively than they are now at front end spend, win more business in Eastern Europe maybe, or more in Asia. But I think that's not the step that the management team is taking now. Is first, let's stabilize, let's back to profits, and after that, let's think about what we do.
Very good. So I think we can move to the next one. So we have David all with us. Just give me a second. Give me a second to yours.
So it's the other end.
Oh yeah, we'll go from a healing product to high-end. Just one comment on McBride. What I'm worried about is that the customers are supermarkets and they're killers. So the day they will see that you have money, you're making profit, they'll come back and probably knock it down. That's my fear.
Right.
I think it should work with. Yeah.
Yeah, okay, so quickly who I am. So sorry guys, I'm not a value investor. I'm more quality investor. Day job, finance director for manufacturing company. And evenings I'm going to clubs and I'm investing also. I do a bit of stock and also option. one day someone wants to talk about options, and also have a blog in French and investing stock market. So especially the French people, you're welcome to go there. So why focusing on LVMH? So Aziz, you mentioned earlier on that Magnificent Seven didn't do very well. Well, actually, I don't know if everyone knows about the granolas. So the granolas are European stocks. So I don't know all of them, but it's mainly healthcare. So it's GSK, AstraZeneca. You do have a bit of like ASML, SAP, Novo Nordisk. That's the best one, obviously. And also LVMH, and those ones have killed the Magnificent Seven. So sometimes you think, let's go to the US to get things, well, we have them in Europe. So that's quite interesting. LVMH, as we will see, has so many characteristics I'm looking for as a value, quality investors. So it would be interesting to view them as well. And yeah, wanted to add a bit of glamour and also performance, most of it. So what is LVMH? It's a big conglomerate, basically 5 sectors. 50% of it is leather and fashion, so Louis Vuitton is Dior. I'm sure your girlfriends and wives know more than you do, but anyway, maybe you know the price of it. It's obviously very pricey. They also have, which is around 20% of the revenue, what they call distribution selective, which is Sephora. And so Sephora is where you buy perfume and beauty products. So it's specific distribution. They also have good booze. So fantastic champagne. This is in Moet. This is Hennessy. So the ones who knows about it will find it. Which is actually less than 10% of the revenue. Third bit is the luxury watches and jewelry. So that's around, I think 12%. We have the numbers later. The revenue, again, big brands, Bulgari, Tiffany's, Tag Heuer. And the last bit is perfume and cosmetic. So it's quite a bit of a decentralized group. It's a bit, in a way, like Berkshire Hathaway. They buy the brands and then they collect the cash flow, and the management is quite independent. Obviously, they have to do well, but they're not quite independent in that aspect. Making 86 billion revenue, and net income, you can see, is quite nice, 15 billion euros, and quite a nice cash flow. Could be more in cash flow, but we will see why. It's not as much. Actually, they invest quite a lot regularly. And then last bit, so the guy who owns it, we'll talk about him later. He's a very rich guy. So you have a 6 box, which is basically newspapers in France. As any billionaire, they like to buy newspapers and talk about them nicely. So that's the breakdown of the revenue between the different sectors. Interestingly, you can see that where they have the most revenue, so it's leather, Louis Vuitton, basically, and all the other brands, they make 40% operating margins on it, which is amazing. Now, the second sector, unfortunately, selective retailing, which they make less margin on, but they still have 8% margin. The sector where they make a lot as well is wine and spirits. There's more than 30% margin. Finally, jewelry, I was a bit disappointed. I would have thought it would be more than 20%, but still, it's not too bad. We'll take it, yeah. And the perfume was really disappointing, 10%. Interestingly, they're still growing in fashion and leather and so on. They're growing a lot in selective retailing. That was hit a lot by COVID, so a lot of shops were closed, and a lot of the selective retailing is also airport retailing. So that has recovered. But at the moment, they're mainly growing in those two sectors, and actually, wine and spirits is still struggling. So I don't know if any one of you have that Geo, for example, the UK company that Geo, that's all right. They're struggling, and these guys are struggling as well in alcohol. Last year, 13% organic growth, which still great. Sectors. So everyone would think that they are really Europe-centered. Actually not. We have a quarter in the US, a quarter in Europe, 31% in Asia. So competitively, you don't want to say how much is China. Obviously, China is one of the important growth markets and has been struggling recently, but we don't really want to say what it is, but it's still doing well there. And Japan, 7%. Other countries, 12%. So it's still quite well balanced in terms of geo.
I'm gonna try with this one because this one I think sometimes it makes some interruptions, but yeah, okay, it's the
Yeah,
same.
we don't want to be, yeah, it's much better. So anyway, we were talking about moods earlier on, and why is it a great business before the numbers? First thing is the brand. So the brand was ranked as 8th in the world, beating a lot of companies like, I don't know, Coca-Cola and so on. You can see the power of this brand. I'm not inventing it, not because I'm presenting it. It was a study. And why those brands are so powerful. So McBride was doing very well, 100 years old. Well, actually, Louis Vuitton, 170, Hennessy, 259, and Moet, is going on the 300 years old. Now, we were asking earlier on which company will still be around in 30 years. I'm pretty sure ladies will still buy handbags and people will still drink champagne, and it's very likely that these ones will be around for the next 30 years. Obviously, having such brands gives pricing power that is massive. The gross margin overall is 70%, and they don't really want to say on bags, but I suspect it's something like 80% or 90% on bags, easily. They're not impacted by inflation. Super rich people will be super rich whatever happens, and people, even if they have less money, they'll still want to look better than the neighbor or show that they have money. That's just human. So if prices are going up, fine, buy them. Last point I think people are less aware of is that they have a massive scale compared to competitors. They're really bigger. They have 6,000 shops in the world, which is huge, and that gives them the ability to do better. So actually, when we'll talk about Tiffany's a bit later, but when I look at their margins compared to the margins of their competitors, in every sector, they're always doing better. Apart maybe Hermes bags are sold like 300,000 or something like that. So it's hard to compete on that, but otherwise they always have better margins than competitors. And I think it also linked to their network and their scale. Finally, in terms of tailwinds, we always want as a value investor to have some tailwinds. It's not AI sort of growth, but still 6% a year. That's not too bad. Knowing that LVMH tends to increase their share of the market more than others. So probably they will do 8-10% a year, hopefully, for the next few years. Now, we're talking about management. I don't know if any of you know this guy. So depending on what Jeff Bezos' divorce has cost him, or what Elon Musk has tweeted, or what Tesla is doing, he's the richest guy in the world. So I think now clearly in front of these guys. What we love as a quality investor is to have skin in the game. You can't do more than him. He has 48% of the company. I mean, if you look at the big Magnificent Seven, you don't have any of them who has anywhere near 48%. And actually, you will see he still buys shares. He doesn't stop there. What I also love about this guy is that he's really thinking long term. He doesn't care about the share price in the short term. What he tends to say is he doesn't care about sales, he cares about desirability. So in the last conference call, he was saying, actually, I could get more revenue. I could discount Louis Vuitton, increase the volumes, but no, what I want to do is that people will still buy it and want to buy it more. So they keep volumes low so they can have high prices. They could do silly watches and things like that. They don't do that. They want to keep the brand really high, thinking long term. The other thing I would say that we're probably not aware of is very, very opportunistic. So probably you're aware there is a real estate commercial crisis around the globe, so mainly in the US, but also in France. So what he's done, he bought what he calls AAA locations in France, so buildings costing him 250 million euros. Fantastic locations. As he says, I have the best products in the world, so I want to have the best location. So Champs-Élysées, apparently, you have 100,000 people every day that goes through there. He's buying it bit by bit. And he's buying it at the right time where prices are quite low. I also wanted to talk about Tiffany's. So actually, he bought Tiffany's in 2019. He made the deal. Then COVID struck. And what he said, he went back to them and said, no, guys, I agreed on the price before, I don't know, 16 billion, 17 billion, he didn't really know. But now the price is less because it's got COVID, so I need a discount. Long story short, we like it or not, he managed to decrease it by, I think, 800 million. Fantastic. So I'm really happy to give my money to that guy. I know he will look after it. That's pretty clear. And as I was saying earlier on, I don't really know the recipe, but I know just the result. I like the food. He's getting better margins than everyone else. And I think I tend to understand why he's getting it. So, for example, Tiffany's, he's just invested $500 million in refurbishing their main shop. Imagine that, $500 million. But it's a brand that's amazing. I mean, which brand in the world has a movie called with their name, or a song? Who wants to know the song? Now, the worry is, as you can tell, he looks good, but he hasn't done much Botox. He's 75 years old, and succession is a worry. We'll talk about it a bit later. Now, with all that, you can see the performance. Even though the company was still big, grew 13% last 5 years, on average. EPS, which is usual with quality companies, EPS tends to grow more than the revenue, nearly 20%. Gross margins sitting at 68%. Amazing operating margin. 24 good cash flow, return on capital 20%, and is not really leveraged 131 that over EBITDA. So as everyone knows, we tend to look at 3 times. Actually, when they bought Tiffany's, they bought it for 15 billion. And I really like what the CFO said. They said, well, there is other companies that are distressed during COVID. Are you going to buy some more? And he said, no, we need to integrate that one, so huge, and then we're going to buy another one. When we were discussing before networking, we were saying that Burberry collapsed, Watches of Switzerland collapsed, and so on. I would really not be surprised if you see in the news in the next few weeks, oh, prices are really low, I'm going to buy Burberry, I'm going to buy this and that. And I'm pretty sure that under his hands, they will get better results. And so those numbers were actually last Thursday, not this Thursday, last Thursday. In between, the Nasdaq has lost a bit and LVMH has gone up. So if you compare LVMH, the last 5 years has beaten everyone with more or less at the same level than the Nasdaq. If you compare to the last 10 years, 500%. Obviously, for the poor people who invested in the FTSE, I'm sorry, commiserations, but still fantastically well compared to the indexes. So, what are the risks I see? First of all is the succession. So you can see 5 young people, and Bernard's nose wife in the middle. So he has 5 kids. They're all in the business. They all have high jobs. So they do very important jobs from one company to another and so on. It's kind of a super The Apprentice thing. He's 75 years old. He's renewed to be there until at least 80. So I think we say for the next 5 years. Now, question is what's going to happen when he retires? I can be worried, but I'm not that worried. I'm pretty sure, let's say he retires at 80 and he still stays chairman. I think the civil war between kids won't start until his death. I think he's been looking after himself quite well. So I suspect he's still, I wish to him another 10, 15, 20 years around. Once he passes away, or once he might be unable to be chairman, that might be a problem. But at the moment, I don't really see it as a long-term, it's a long-term problem, but mid-term is not really a problem. The other risk that often we mention, first is the Chinese market. China is doing very badly, but it's still growing 5%. Middle class is still growing, and I don't see why they will stop buying such stuff. Also, if there is a trade war and so on, it doesn't really impact it. It's not strategic if they buy bags or perfume. And second thing, you can put all the tariffs you want, they won't care because customers will pay the price that is needed. The other thing is recession. So I have a little question for you guys. Last recession, 2008, 2009, how much do you think LVMH revenue went down at that time?
Probably not, because they're not selling to middle class or upper middle class. They're selling to the 5% to 10%.
So yeah, in fact, it's a bit more, it's 20%. But still, they could lose 20% for a few years, that would bounce back. So it's no real risk here, as far as I'm concerned as well. Now, one of the big points is, can they still grow? So I said yes, but they can't grow that much. It's either buying competitors, or where they're going to grow is probably selective retailing, where they have the lowest margin. So that's a bit of a worry. Valuation. So you were asking for valuations. So here you are. Current PE is recently quite slightly higher, it's around 25, 26. Excluding the COVID period, the average was 23.8. May seem high, but not too bad. Forward PE 24.6, the same area. I was doing a DCF. If I want 10% returns at 633. Now the stock is currently at 800 euros, 790, 800 euros. So you still have a lot to come down to hit the DCF. Now the problem with that stock is it's always expensive, as I said earlier on. So maybe a way to do it is either you do a reverse DCF, which shows that it's still a bit expensive. We're talking about growth, so Bernardo would be happy with 8 to 10%. So 10.7, you don't have any margin of safety, and that's a bit risky, it's a bit pricey. Now the good thing is he buys back his stock, and 3 months afterwards you know how much he bought it. Last year there was a scandal with him allegedly not paying enough taxes, like any rich people, and the stock collapsed. That was an opportunity. Every year it tends to come down a bit. So anyway, 670, 665, where he bought it last year. Again, an opportunistic guy that knows well his business. So valuation is difficult, but I would say it's between 630 and 690. If it comes down to under 700 or around 700, that might be really interesting to get the position in, if you're interested. Now, conclusion, yeah, suffering solid returns. I think that's pretty clear. Personally, I prefer owning a stock like this than an index. Index, yeah, I own a lot of the great stock, but I own so much crap. Here, I know it's quality. If there is a market correction, this stock will come down less than others. That's pretty clear. If you're interested, this kind of technical analysis study every year tends to come down 15% from the highs. That would give, let's say, 740. And during the last two bear markets, which were COVID in 2022, that came down 25%. And that were great opportunities. Actually, for the ones who followed Terry Smith, he bought it during those opportunities. He was saying specifically, I've been wanting to buy it for the last, 100 years, but he's not young as well, and he could only buy it when there is big drops. So you need to keep it in mind. Need to be patient, and clearly if it comes down to around 700 or something like that, I might be tempted. Or if I realize that he bought the shares by 750, I would be reviewing my view. He's opportunistic, he knows it, so knows it better than myself. Okay, so thank you very much. Any
question? The microphone is here. Still has a question?
I can't remember where I read, but there was an article about Penman's family. And you nailed it on the head. I think the biggest problem with this business is the succession. Yeah. And it's interesting because you're right, he's going to be around for 5 years. He might stay as chairman for a few more. And your point's valid. On the medium term, who cares? Long term, yes, it's a worry. We'll have to see. I guess I've never looked at it in detail, but my assumption is he must have some good management team behind him as well. Do we know much about that?
Yeah. So actually, one of the issues is that management teams were more or less his age. So his deputy has retired. I think another guy has retired. The CFO is still very good. I mean, he doesn't look like an old man and he talks very well. That's one of the issues. Now, on the topic, his kids are also getting older, so they can take over. Actually, his daughter is heading Christian Dior, which is one of the biggest companies behind Louis Vuitton. It's also the holding. So, yeah, but it's true that's a problem as well. I can't really tell you because most of them are retiring or recently retired. We haven't seen it in impact yet.
There was an interesting point. I think the guy he took it from, who was the richest man in France, I think, he didn't have any children, so he decided to have two men.
Well, I think it's Christian Dior. I think it was Christian Dior. There was no inheritance for Christian Dior, and the group was distressed. And I think he bought it for one French franc.
Yeah, it was as a bankruptcy because I think he was bought. So the original owner in the 1940s?
80s. Yeah.
Something long, right?
Yeah, he bought it.
And a little bit of a nasty thing because we say that he would keep all the jobs that LVMH will keep all the jobs in north of France and otherwise.
Yeah, he's a killer. That's for sure.
Yeah.
Hi, I'm Chris. Last presentation. Thank you very much. I would like to mention something about valuations, okay? The way I like to think about it is if I buy the whole company, which I just checked is about 400 billion in euros, and I want a 10% return every year forever, that means I need to get back about 40 billion, 40, in free cash flow forever. Now the free cash flow for this company is 20 billion. So that means if I treat it like a bond, it's a bond with 5% yield. But a bond doesn't have increase in the yields that it provides. Now, assuming that the company can grow, that 5% will become more in the next 10 years or 20 years. So the point is that a better way to think about valuations? Like if you buy the whole company, and you say I want 10% return, that means I need 40 billion, 40, in free cash flow forever.
I mean,
But now it's about 5% in the same sense. But that assumes the zero growth, which is not the case probably, because as you mentioned, there's going to be some growth. Now, understand, I try to compare it with a bond. Like if I have a 5% yield bond, and this one is a 5% yield as a free cash flow, it's the same thing.
You can try now.
this one. Yeah,
You understand the point?
the comparison with bonds is,
Yeah, it's not 100%, yeah.
if I'm perfectly honest, if you ask me, lend money to LVMH or Microsoft or lend money to the US government or the UK government and so on, I would not give it to a government. I think it's much safer here. And this is where, for me, it's a bit of struggle when we say, okay, I prefer to lend to the government, to invest in the government, rather than a business like this. So I think really the risk here is still richly valued, as we said. And if we want to get the valuation that is 790, you need a growth of 10%. That's not good. I haven't done the DCF for 5%. But if I was doing the DCF where the return I'm expecting is 5%, I'm pretty sure it would be over €1,000.
And of course, we have the buybacks, which increase value together with the EPS growth.
Yes. So he doesn't do that much buybacks. He buys them himself. Like he doesn't do that much buyback.
So can I say something on that, on the previous? So if I buy a company like that for 400 billion, 400, and the free cash flow is 20 billion, okay, I have 5%, let's say, yield. But if there is a growth of 10% per year, that means in 7 years from now, I will have a yield which is 10% yield. And if it continues like that, in 14 years, I will have a 20% bond.
Yeah.
So it's an amazing investment compared to a bond or a fixed income.
Exactly.
Yeah,
you know, it is the compounding effect of a quality company.
Yeah.
If they continue to grow, well, yeah,
The price probably matters less. It's the internal return that shows off. But I have a question on that. I have a comment on that. If you don't have a comment, anything. What do you think about the maximum size that this company can reach? Because in nature we have, I don't know, elephants or whales, and at some point it becomes too big. Probably it's not the biggest company in the world, but do you think that there is a size that then it won't be able to grow anymore? So this internal return, this high internal return, at some point, let's say in 10 years, it will. There is no other room.
Yeah, are you married?
No. Why?
So you don't know the answer. I'm married. My wife cannot have enough handbags. Okay.
So I think you need to do very well in your stock investing. Huh? No, I think it's a very good question. I think at the moment they grew already a lot in where it's profitable, and now they're going to get growth elsewhere. For example, I saw that they're doing luxury holidays now. So he bought the Orient Express company, the trains. I think now he owns it. That's luxury. It sounds good and so on, but it's expensive, and I don't think you make that much money. So this is where it's difficult with that company indeed, is that they probably doesn't need to go in other sectors where they make a bit less money. But still, we saw that the market should grow 6% a year. 6%, they will do better than competitors. They will buy some competitors. So I still think they can do 8 to 10%, which is the target of the CEO. So yeah, after 10 years, I don't know what will happen, but hopefully I'll be richer.
And one last thing on the whole thing. So what I found so far by experimenting, I'm not a professional investor, I'm an engineer, but I like investing, is you get great companies like that, like Coca-Cola, Berkshire Hathaway, Apple. Okay. The problem is they're too expensive. So if you get the option of investing in an index fund in a risk-adjusted way, probably the index fund makes more sense. Now, if you catch a company like that in the beginning of the growth, of course, it makes more sense. But these great companies, it's like buying an index fund at the end of the day, if you want to buy these great companies, because they're already priced, they have the quality priced. Am I wrong on that?
Okay, I think there is this philosophical debate here. I think it depends if you compare to, I don't remember what the average, for example, return on capital or operating cash flow of the S&P. But it's probably not as good as that one. Then the other question you ask yourself, the S&P, what is the P of the S&P at the moment? I think it's not that far away from that one.
Yeah, about 22 times.
22 times. So would you have a company like that at 24 times, or would you have the entire S&P at 22? That after is the question you need to ask yourself.
It's about the same thing at the end of the day. Because in the other case, you are not worried about succession if the person dies or so. So, in a risk-adjusted way, maybe it makes sense. It's the same option at the end of the day. Maybe one is a bit better than the other, maybe the one is better.
On this one, I say if you have to look on the plus side for this one, you have exposure to euros, which you don't have by definition with the S&P because you're exposed to dollars. So, and if you look at European indexes, you struggle to have American sort of returns on European, like on the Euronext or something like that. So you need to pick a bit more, cherry pick, be a bit more selective on your investment choices if you look at European stocks. In which case, yeah, this one seems interesting. The question I had was, I didn't look at their numbers, but also how they use debt.
Debt?
Yeah, do they tend to use their operating incomes to grow the business, or do they rely on that? I mean, how do they manage it?
So, okay, the debt is relatively low. I mean, 131 against EBITDA, but basically how many years it would take them to repay all the debts.
Right.
1.3. Normally, Gaël is a financial analyst. He'll tell you 3. Or maybe he has special basis. The rule of thumb is you need to be under 3.
Okay.
If they do a big acquisition like Tiffany,
Yes, for example, this one.
some debts,
Okay.
and they would be able, I mean, for example, they bought Tiffany for 15 billions.
Right.
Now they're making 50 billion in free cash flow. So they could buy a company like that in 1 year.
Okay.
Now, Gaël, we can take this one as well, but Gaël, if you want to come up, so if there are questions that you want to ask to both speakers about their way that they invest or anything like that, Gaël, you can come up as well, and
Sure.
we can share a few more questions, and then we will close, right? Yeah, sure. Go on. Sorry.
Thank you. So I wanted to ask, I assume obviously that Bernard Arnault doesn't have any other source of income. The company don't. The dividends from the company are effectively when he has cash. Then you showed us that he's buying the shares. So he will need to be, I assume that he gets the dividends and then he basically using this cash buys back the shares of the company, which is first tax inefficient. So have you thought about why is he doing that way? Why is he not giving that here the control? Why he's not doing something more tax efficient, which would be effectively doing the buyback instead of cutting the dividend?
Okay, so I don't know. I suspect that when you do some buybacks, every shareholder benefits of increasing their holdings, whereas when you're buying yourself, you're increasing your holdings and the others are not having their holdings increasing. But
I mean, rich people have other ways to like cash rather than just dividends.
Yeah, I mean, usually, I mean, it's
What do you
like,
mean?
they would have options that they can exercise. So, like you take the example. I mean, if it's
I don't know if it's similar for this company, but like for example, I looked at it for Tesla, for example, because I was wondering how Elon Musk was getting so much shares, and so they have goals that are based on the performance of the company. So let's say LVMH is hitting 15 billion in free cash flow, then the board agrees to give them the option to get at a discounted rate many shares. And then they have their goals like that. So then for that option, either they pass on it and they don't buy the shares, or they can actually pass it and they get them at a discounted price. The other thing also to keep in mind is that I don't think France is very much into French companies are very much into buybacks. Feels to me like it's more an American thing.
No.
Yeah.
Think you have two things. You have the company and himself. I think it's a great thing that he doesn't just think about himself, he also thinks about the company. If he thinks for the company, he needs to keep the cash to invest rather than do buybacks. And then his own cash, he buys shares. That's fine by me.
That's why I'm saying he could walk into any large bank and take a 30 billion credit line. Yes. 30. Okay. And at maybe at 4%, maybe at 3%, any bank would give him that money. Yeah. That's how these guys don't have to sell their assets to get money. You know.
Actually, paying dividends, yes, it's tax inefficient, but when you have a lot of employees who have a lot of shares, it's really good for them. For example, Meta has started to pay dividends, and that was really good for the management. Because you have some shares, you can't do anything with it. Yeah, you're rich in terms of shares, but if you don't sell them, you don't recover. So also your employees like to have some dividends. Yeah, I know you're thinking is not tax efficient. I understand. But other people have another view on it.
Now, some combined questions about either the speakers, the investor, something general that applies to all of them. And if you want, you can also come to the stage, right? And we can close like that. We can make 2-3 questions that they go to all speakers, if you want. Yeah.
Yeah. I don't know. In terms of buybacks, probably it's some difference between Buffett and Arnault. If we can compare them, Buffett would obviously never pay dividends and then buy shares. But I guess like luxury space and Arnault is different. So my question on succession and probably on management more general, actually, by coincidence, today's annual general meeting of LVMH, it was like during the day. So as you mentioned, like really well thought presentation. Thank you very much. I mean, as you mentioned, the number 2, Belloni, I think his surname is retiring. So Stefan Bianchi was appointed as number 2. He was the head of watches and jewelry before. So what do you think on succession? I mean, because I've been trying to understand like who among the family has like leading position in terms of role and stuff. Like, what are your thoughts on succession? I mean, within family, or can we expect that it will be outsider? I mean, not with the surname Arnault, like, I don't know, like Stefan Bianchi, for example. Yeah.
Personally, I'm pretty sure it's going to be an Arnault. He's terrorized of giving the business to someone else and then it goes away. And I think he's trying to get 50%, so he can give 10% to each of his kids. Now, the funny thing is the guy who's voting used to be in Yves Rocher. Yves Rocher was also a family company, and this guy was kind of a mentor for the next generation. So I think apparently he did an amazing job. He did a turnaround, and then he stayed a few years, and then the family took over. So I suspect he took this guy on to also mentor the young kids. At the end of the day, I don't really care who's going to be I think they have good genes, and they had honestly, they had this MBA. If you look at their CVs, 3 years there, 3 years there, 3 years there, and this kind of guy who's taking their kids when they're 10 years old to do business meetings with them. So at the weekends they were going around with their dad, following them in the shops and checking things. So yeah, I can't really tell on that.
And probably on valuation, and you mentioned Burberry, like it hits like 4 billion valuation recently. It's like really cheap, 10 PE. So like gross margin comparable to LVMH, not that bad business. So obviously can be acquired because it's not family owned. So like what are probably your thoughts on like what is better value? I mean, LVMH at these levels or a bit lower, as you said, let's say 700, or is it value in like much cheaper names like Burberry at 20, I mean, Kering at 14 with comparable margins. So just to understand like how to better gain exposure to luxury sector. I mean, because big disparity in valuation.
So
two types.
So I looked a lot into Kering. Actually, I owned Burberry as well before. For me, it's all about the management. Kering, he tried to do the same thing in buying buildings in Paris. And then what happened? He said, "Oh, I'm buying the shop, but I don't want the offices." And he tried to sell them back, and it was a complete mess. Also, Kering, interestingly, used to be a guy called François Pinault, who used to be heading it. Now it's his kid who took over. For the cinema fans, he's married to Salma Hayek, well done. But I think he's more focused on the cinema than on his business, apparently, if you look at the performance. So they would never buy Kering, but for companies like Burberry, I say it very, I think they could do very well. And where LVMH is good is if they have one sector that does badly or one company that does badly, it doesn't matter, because overall it's okay. Burberry, their sales are dropping a bit, then it's the end of the world. It's a bit like Kering. I think 50 or 60% of the revenue is just Gucci. Gucci dropping 10%, finished. But it's a great opportunity for them. If they're able to buy a business at 10 PE, they incorporate it directly, they'll go with their PE of 24, something like that, roll up, adds value there directly. And again, I think that because they operate better than the others, don't really know why, but have guesses, Burberry would do better under their management. And I think it's because they're investing. I mean, they bought Tiffany's. Tiffany's was an amazing business. They were making less margin than the equivalent in LVMH. That is crazy. They should do more margin than anyone else. It's because they were underinvesting. So you take those great brands, increase the desirability, invest in them, and then they make more money. I think it's a great opportunity for him to do things.
I have a question if nobody else has. So that goes for all speakers. What would make you change your mind or accept that you were wrong in your assessment, like scenarios that you have thought that, and what will you do in that case? Will you sell? Will you just accept if you have thought of the bad scenario in your case? And I will start, and you can talk generally for stocks if you want as well. Yeah.
Yeah, so sometimes I get it right, sometimes I get it wrong, and usually I sell if I don't believe in the story anymore. If I see the company not doing as it was expected, or its sales are going down, or profit are going down, or losing market share, whatever it is. If I realize it's not, it doesn't look good, the short, medium, or long term, I just sell, accept the loss, and then move on, to something else.
And would you say even if it's 70% down, you will just sell, or you will say, okay, now, anyway, I lost what I lost. Because I personally, for example, I insist, which might be wrong sometimes. I say, okay, it is what it is, let it be. But you will sell probably if you see that things are not going as. Yeah?
Yeah, I think so, yeah. Yeah.
Okay.
It's funny, I remember speaking to private equity owner, the private equities, they buy companies and then 3-5 years later they sell them, make more money. So one day he told me, they have a private equity, if they own a business for 10 years, it's a short-term investment that has gone wrong. So, so it's that sort of mentality. I'd rather just sell, take a loss, and then find something better, to make it up. And
Ilias, what about you?
Well, it's actually a problem that I have at the moment with Meta, because when I looked at them back in 2022, when the stock was hitting $100, they had no debts. The cash, they had a lot of cash, and yes, okay, there was those metaverse issues, there was those hearings at the Senate or wherever it was, but they were still making money, and I was like, okay, I can't really see what could go wrong there. And yeah, I mean, now the stock is things went well, the stock is went high, and to be honest, I don't know what to do.
What will make you? Okay, I will sell better. Like what?
Yeah,
What do you happen to say? I will sell.
Basically, preparing those slides, I was hoping that I could see that Meta was definitely overvalued, that definitely there was something wrong, but it ends up still being one of the cheapest of the big ones. So you're like, okay, maybe I can carry on keeping that stock in my portfolio, but yeah, always worried that some point there everything's gonna go away, so I never quite know what to do with that. But yeah. Otherwise, I think the story is important. Usually, for me, the warning is that I try to stay away from companies that have a high level of debt, because that's especially when we have high inflation scenarios, and that refinance can become more expensive. I can really see that as a big like long-term growth feature. So, yeah.
David, okay.
You want the official answer or the not official one?
There is no way.
No, okay. There is this what we should do and what we do in real life.
Yeah.
That's the problem. So what we should do is, if the story is wrong, or let's say I have some caring, for example, and I'm realizing that the management is poor, what should I do? Because I think it's undervalued. And I think that's the problem. Is often you realize that you have a stock, for whatever reason it came down, is undervalued. Shall I keep it, waiting that it goes back to its own value, or shall I sell? And it's kind of a mix. So I bought some Chinese stocks.
Alibaba.
So yes, so I'm not going to cry, but I want to. What do I do with it? Because fundamentally the business is still growing. It's a better business than 5 years ago, but the share price is down 80%. It's completely undervalued. So to be honest, what I'm doing at the moment, I'm keeping it, because one day China will go back in. So you have another strategy would be, okay, I'm taking my loss on Alibaba and maybe I put in LVMH. I don't know, but I think it's really difficult to make this mental.
Yeah.
Difficult to admit you're wrong. That's like.
And the problem with Alibaba is that now it's becoming. The problem with it is also you have to price the time that you've lost not having that money invested in something else.
Yeah.
Yeah. Now it's been the same problem.
So to be honest, if you think it's going to come back to the intrinsic value, so doubling in 2 years or 3 years or 4 years, that's okay. I'll wait.
Yeah.
And then you have the master thing, which is taxes. So sometimes you do tax harvesting, especially with the UK.
You can do stock.
Well, you can take your profits on some, and then you neutralize your profit with some losses. And then, so to be honest, because the rate is like 20% or 25%, or depending on how much you pay taxes, then it makes a difference.
All right. Now it's just doing everything.
So you suggested that, I mean, if you lost hope, I mean, in the end, you can just.
Yeah, if you lost hope, you just sell, and that's it. But if there is
way, I mean, or simply you think it's easier.
If you lost hope, if you realize that you own crap, let's just shift it.
If you have another combined question like this one that we can ask to all all speakers, that would be great. Otherwise, we will close and then you can mingle and we can go offline. But if you have something nice that all speakers can answer as an end.
Within your opinion about that, when to sell.
Anything else? No?
I would like to say something about this.
Okay, think that. Oh,
Yeah.
okay, go.
Of thinking like buying the whole company, because that's the way. After reading a lot, this is how it's. Warren Buffett says it's the best way to think about. Like if you're a business owner who wants to buy the whole company. Imagine now the Nvidia is 2.3 trillion, and the free cash flow is 30 billion at the moment, 30. So people who buy Nvidia at 2.3 trillion, they're expecting, if they want 10% return, they're expecting that the company will make 230 billion. And when?
That's literally the presentation we know here today.
Yeah. But if you compare the two companies, so one makes 20 billion and it's 400 billion euros, and the other one makes 30 billion, 30,
Yeah.
and it's 2.3 trillion market cap. So that's a much better option. The problem with the index funds that I mentioned, because this is the way I invest after researching about it for a long time, is you own a lot of junk. That makes my stomach. I own Nvidia because it's part of the index, but I don't like that. Now you can buy companies like Louis Vuitton or Coke or Berkshire or Apple, but then you have a lot of costs at each transaction. While index fund is like 0.07% or something. So this is where I'm a bit confused. I can see the value in both options. But I don't like to own Tesla or Nvidia. Long-term investing. Long-term, yeah.
Okay.
But I cannot understand why people buy Nvidia at this valuation.
That's
This is hype. I mean, it's yeah.
I can play the Davis advocate quite I agree with you, but I can play the Davis
Sure, yeah.
control just for that. Okay. So most of the time, your logic is true. And I would say that, and I would write about that back in 2013 or 14 or 15 or 16 about Tesla. And then I realized it's not only the price that, okay, it's battling, but you see that when I said in 2014 or 15 that this is a bubble that doesn't make sense, now if I see the revenue and the net income, not the stock price, I'll see that that price in 2014 made sense. So I have in my mind that 10, maybe 19 out of 20 times your logic is right, but sometimes something happens that 5 years ahead might happen, like maybe it's 5% possibility that we may say, that valuation of 2 trillion of Nvidia or 1 trillion made sense, and I don't disagree. I'm just playing the advocates.
It's more like speculation in that sense, not like investing.
It can be speculative. Go on.
So I really think it's I really think it's the hype. This
An outlier like a video. But what if someone said to you, I'm looking at Amazon in 2000?
Or in 2000.
You're picking an outlier and saying Nvidia, of course, Nvidia is overvalued. Some people might not be over, you don't know. But if you were to pick something that's undervalued now, your logic doesn't.
Yeah, because you expect it will grow a lot in the future.
It's not just expectation, though. It's your control. Yes, but you're also expecting as well. It's not true. But with your version or my version, if I find a company that's a good quality company, good balance sheet and whatever, I can see the cash flows. I go back 10 years, the cash flows have been stable. I can relatively project forward and think, okay, the cash flows will be this, and this is the kind of growth I expect. With yours, how do you measure?
So probably not related to Nvidia, but related to when to sell high quality companies. Because again, For example, a couple of months ago, I've been on presentation of like one of the best high quality funds in UK. They called them Hermes, and the question was like, are you going to sell Hermes at some point on valuation? Because it will be like it's very high, but it can be even higher. So, like, would you sell LVMH on valuation reasons? I mean, can you imagine valuation? Because I like buy and hold, quality companies, LVMH is great, but can you imagine like valuation level at which you would sell?
Okay, so me personally, I don't really. Okay, if it's, let's say, 100% more than my valuation, I might sell some of it. Otherwise, I try not to look at valuation because I can't really do market timing. I'm selling tomorrow and carries on going up. Normally, those businesses, they should compound and go up in time. So, yeah, I don't really count valuation as one of the criteria to sell. It's more the business itself. Personally,
Do you apply any rebalancing for your, so when sometimes valuations end up like being just divine, and so you don't want to completely go off your position, or maybe you want to kind of not be the prevailing part of it.
what? Okay, rebalancing. I don't really mind because I don't think it this way. If I'm doing rebalancing, it's let's say every year I have, I don't know, £10,000 to invest. Where I'm going to put it, or if I'm thinking, oh, I have this great business that might have a return, I don't know, 200% in the next 3 years, and I have this one that is great that might have a return of, I don't know, 20%. Maybe I'm going to sell it with the 20% to reinvest in the 300. But the rebalancing is really if you are a fund manager where you have a portfolio and you have roles where I can have more than 10% and so on. But you don't want to cut your best runners, you know? So yeah, I don't really do that as a private investor.
Shall we close? Like, do you want anything else to comment? No, okay. Go ahead. No.
So I think that was a really great discussion. We were fewer people, but I think that was a really good discussion. That's one last note about the speculation stuff. And this is about people to read Nicholas Lip letters, who is a UK manager. And this is a good the other opinion of how somebody who seems not to be a speculator, because I guess that most people who go into that, they speculate. But you can see some logic of a non-speculator buying something that appears very expensive. But I'll just say this also to the audience to check about Nicholas Lip letters. And I don't follow that logic, but I find some value there. So this time we had 3 French speakers, right? France should be very proud of this event. So a big round of applause for our 3 speakers. It was a really enjoyable session. So now we will close, we will go fly, and we will mingle. Thank you for attending, and thank you for attending online as well.